Canaccord Genuity chief market strategist Tony Dwyer joins us now. Tony, what does chillax mean?
So I'm in the kitchen. How many times that the teenagers came home and did something I thought was outsized and outrageous, and I would have the normal dad reaction, and they would say chillax, like it wasn't as big a deal as they thought it was. So that's what made me think about it. So in this kitchen, there was
David to chillax 5 minutes ago.
Yeah, did you? Yeah, I think, yeah. We use it here, too.
So,
yeah, I'm being told to chillax, like an old dad as well, Tony. But why investors' approach to the market? What do you mean by that?
So I think Sarah, had a very interesting, you guys have been talking about, they were fine. They were fine. And so when you're in a historic oversold level like October 27th, when bond yields are spiking on the Treasury, supplying they're fine, that's a reason to expect a pretty snappy bounce, which we got, as you guys have talked about a lot. The environment then was ripe for a rally in the bond market and a rally in the stock market. Now everything's kind of fine. You need that next catalyst, especially if I suggested that back on the 27th when we were looking for the rally, if it was going to be 9 or 10% by the end of the year, everybody would have taken that hands down. And now that it's up that fine, apparently, is good enough for a further rally, and that just doesn't match with our data. So right. We're just, by the end of the year, guys, I think there's not a big story to make, and that's the chillax theme. It's just I think that prices will end the year around where they are. So if they go up a little bit more, they'll pull back to where they are. If they go down some and on an overbought correction, they'll lift back up to where they are. Got it.
All right. So let's assume we end the year, at least as you say, roughly where we are right now. What are we thinking about next year at this point, Tony, and how, if in any way, is are your forecasts being driven what you're seeing on the ground right now in terms of retail sales or out of this earnings season?
It's funny when people like me come on TV and they say there's we're going from a 27% chance of a recession to an 18%. I don't know what that means. You either expect a recession or you don't, and I do. We've had 22 months in a row of negative leading economic indicators. It's never been at this level without a recession. We've got money supply that's still negative. So all those things, guys, this is all about money and how the money can end up creating better revenue and better earnings. As you guys just described with the retailers, there was pretty good disappointment there. So unfortunately, I think we're in this zombie environment where the expectations, until you disprove a soft landing via either an acceleration that only comes with a significant and sustainable drop in interest rates, or you actually go into a recession, that's the only way, to me, that you can really kickstart an improved outlook for money. The market typically bottoms in a recession because interest rates on mortgages, corporates, treasuries, they all come down significantly. Even in soft landings, they come down significantly. So our base case for next year is that we're in a recession. If we're not now, we will be. That's going to create a much more dramatic drop in yields than folks expect. And guys, that is just going to kickstart a real significant recovery toward the end of the year. So it really depends on the interest rate environment as to where we are a year from now. And I think it'll be at a better place, but not without a little bit of choppiness ahead for sure.
Well, a little bit. I mean, if you think that there's going to be a full-blown recession, Tony, that's not in the market as far as our earnings expectations and the S&P. So that's a little more than a few bumps, don't you?
Yes.
What do you expect? You expect a drawdown like 20% that we could see in a recession-type scenario?
So a lot of the markets, Sarah, as you know, already, so when you're looking at, say, Target, and it's not a comment on Target, or the retailers we've talked about, or the financials, even back in October, when the banks are down 50%, when the equal weighted stock is testing last October 22 low, when you've had 33% from 52-week high for the average stock in the NYSE, I do believe that a lot of the market is discounting a recession. And in terms of earnings, TJ, my earnings wizard at Refinitiv, sent me the data on the Magnificent Seven's impact on earnings. And earnings are negative 2.5% if you take out, this is as of early November, if you take out the Magnificent Seven. So expectations for next year, I think, are a little high, but it's real. Guys, there's no world 2 years into this. And Sarah, you guys know I've been pretty cautious for 2 years. Yeah. We're 2 years into this. As I've said so many times, now is not the time to get negative on the average stock. Could you see a drawdown in the mega cap tech stocks? I think you're going to probably for years relative to the equal weighted stocks. They just haven't pulled back yet. Most of the market already has. Even as I look at my data this morning, guys, the average stock in the NYSE is down 28% from its 52-week highs, according to my friends at Ned Davis. and 53% of stocks are still down 20% or more from their 52-week high. So to say that the market's not discounting a recession, I think is just the S&P 500 isn't because of the Mag 7.